The island reversal is one of the most dramatic and emotionally powerful reversal patterns in trading. When this pattern appears, it feels like the market suddenly abandoned a group of traders and moved on without them. That's exactly why it's called the island. Price leaves traders isolated, trapped, and forced to react. An island reversal forms when price creates a gap in one direction, trades for a short period of time, and then creates another gap in the opposite direction, leaving a group of candles completely separated from the rest of the chart. Those candles in the middle are the island. There are two main types of island reversals. The first one is the bearish island reversal and the bullish island reversal. Same structure, opposite direction. Let's start with the bearish island reversal. This version usually appears after an uptrend. Price goes up, often on strong news or bullish sentiment. Buyers feel confident. Readers chase the move. Price trades in the higher areas for a short time. Then something unexpected happens. Price gaps down, leaving all those bullish candles stranded above the market. There is no smooth transition, no gradual exit, just abandonment. This tells you something very important. Buyers who enter late are now trapped. Their stop losses are far away. Their exits are limited. That sudden shift in sentiment often leads to aggressive selling. Here's a simple real-life analogy. Imagine stepping into a small island during low tide. You feel safe, everything looks fine, then suddenly the water rises and cuts you off from the main line. You're stuck. That's exactly how trapped traders feel during an island reversal. Now let's look at the bullish island reversal. This one forms after a downtrend. Price gaps down, often during panic or bad news. Sellers feel confident, fear is high. Price trades at those lower levels for a short time. Then suddenly price gaps up, leaving the bearish candle isolated below. Sellers are trapped, buyers take control. In both cases, the power of the pattern comes from the gaps, not from candle shapes. The gaps shows urgency. They show that the market changed its mind without warning. Island reversals are especially common in markets that can gap easily, like stocks and indices, but they can also appear in forex around weekend opens, major news events, or session transitions. Now let's talk about the psychology behind this pattern. The first gap pulls traders into the markets emotionally. Greed or fear increases. Positions are opened aggressively. The second gap does the opposite. It removes liquidity, it removes exits, it forces traders to react instead of plan. That emotional shock is what fuels the reversal. In smart money concepts, island reversals often appear around liquidity traps. Institutions allow price to gap into liquidity. Retail traders chase the move. Then price gaps away, leaving those traders stranded. Now let's talk about confirmation. The island reversal is already a strong signal by itself, but traders still look for follow-through. Strong momentum away from the island confirms that the reversal is real. One mistake beginners make is trying to fade the first gap. That's dangerous. The pattern is only clear after the second gap appears. Before that, you don't have an island, you just have a gap. Another mistake is ignoring context. Island reversals work best after extended trends, near major support or resistance, or during extreme sentiment. In choppy markets, they lose power. Let's make this very practical. Imagine a stock gaps up on great earnings. Everyone is bullish. 2 days later, the stock gaps down hard, leaving those bullish candles isolated. That pattern tells you the smart money already exit. Late buyers are stuck. but same logic applies in reverse for bullish island reversals. Now, one final analogy to lock this in. Think of a train platform. You step into a train thinking it's going forward. Suddenly, the doors close and the train leaves in the opposite direction. You are no longer in control. That shock is the island reversal. So, to summarize, an island reversal is the sharp reversal pattern built around two gaps. Price gaps in one direction forms an island, then gaps in the opposite direction. It signals trapped traders and a sudden shift in sentiment. There are bullish and bearish versions. It works best after strong trends and emotional market conditions. The island reversal is the market saying, you follow the crowd, now you're isolated, the direction has changed.